Okay, welcome back, everybody. In today's interview with Stan, we'll be focusing on a few different concepts. And to start with, I'd love to talk about short selling and that process in general. And to kick things off, Stan, I'd love to just kind of open it up with kind of a general question. What are some of the common mistakes that traders make when shorting?
There are plenty I've seen over the years, but probably the most egregious is selling short, which the fundamentalists often do, is that people sell short because they decide, the stock is overvalued, it's overpriced, and whatever. And to me, that's a prescription for disaster because overvalued isn't enough, especially if the stock is still in stage two. Because as I've seen so many times over the years, and not just individual investors, but professionals too get killed because if the stock is still in stage two, a bearish move can become much higher, and what looked to before to be like overvalued can become even more overvalued. So it's absolutely crucial that you don't consider even putting a toe in the water on the short side until the stock starts to roll over and it at least moves into stage three, when you can then do initial shorting. Thereafter, it undergoes a distributional top, and down the road it then breaks down and moves into stage four. That's what makes it become a really exciting and aggressive time to do shorting. But before leaving this topic of mistakes, there's a second mistake that we have to touch on, and that's where a lot of times a trader investor doesn't know where they'll get out of a short if it turns out to be wrong. And sometimes only the liars are never wrong. So you have to define what your risk is and where you're going to get out with a protective buy stop if it doesn't go your way. Now, those two factors, I think, are the most crucial.
And I also wanted to ask you if there's an optimal market environment where shorting is really the number one thing that traders and investors should be doing.
There is obviously, again, common sense goes a long ways. Just as in a bull market, at that time you want to do aggressive buying, especially on pullbacks and on breakouts when they move into stage two. In a bear market, you just have to turn things on their head. It makes sense to short when the overall market's negative and stocks are breaking down and completing tops and moving into stage four. And then the second time, after the initial sell-off, if it worked and traders will take some profits, there'll usually be at least one snapback rally toward the breakdown. And it's important, we've spoken about this before, the prior floor of support, then usually 9 out of 10 times will become the area of resistance on the rally back up. That's the time, again, to do additional shorting.
And Stan, I want to ask you, what stocks and areas of the market should traders focus on when shorting? Basically, how should you find short ideas?
I don't really think there's a go-to area where you should look to short. For me, it's simply looking to short basically the weakest stocks in the most negative market sectors when the overall market, in addition, is telling us that it's a time to do aggressive shorting. One other caveat is I don't like to short stocks that trade very thinly. Doesn't have a lot of volume behind it, as there's a much greater chance of a whipsaw occurring and getting a false breakout and thereafter getting jammed.